I'll tell you. For example, you're just starting a business. Okay. For that, you just need 10 lakhs. Okay. And you are borrowing a loan of 5 lakhs from a bank. And bank is giving you this 5 lakhs at 10% interest. Okay. So you'll be getting the remaining 5 lakh from your investors, right? You'll be getting the remaining 5 lakh from your investors, wherein you'll be expecting a return of 12%. So to keep both the bank as well as your investors happy, you must at least earn the cost of that capital. That is more than 10 lakhs. Then only you will be happy and you can make your bank and your investors happy, right? So the cost of capital is nothing but this is the required return on your borrowed funds and your invested funds. You are able to invest 10 lakhs and you're getting 10 lakhs. What will happen? Neither profit nor loss. Then what is the use of doing business? Right? If you're getting less than 10 lakhs, then ultimately you will be very sad. More 10 lakhs, you'll be very happy. And even in this case, you're making your bank as well as your investors happy.
Madam, which block, madam, this is?
Which class? Business finance class.
No, no, block, I'm asking.
We are in end of block 3, cost of capital.
Okay.
Okay. Now you are asking.
No, madam, block, I'm asking.
Ah,
Okay, okay. It's there.
okay. So this is how you can make your bank as well as your investors happy. Now, next coming towards what are the views on cost of capital? Okay. Basically, there are two major views how you can interpret your cost of capital. The first is your traditional view, and the second is your view, we call it as. That is Modigliani Miller view. This is one of the modern view. Traditional view is the oldest one, and modern view is, we call it as view. That is Modigliani Miller view. First, coming towards your traditional view. Okay. In your traditional view, cost of capital is not fixed. Okay. You can either minimize or maximize by maintaining an optimal mix of debt and equity. If a company is using more debt, okay, if you have taken more debt, ultimately you have to reduce your cost because debt is cheaper than equity. Okay, if your debt increases, what will happen? Your financial risk increases and your interest payments increases at the same time, right?
Yes, ma'am.
Yes. So this is how your traditional view goes on. But what is the modern view? Modern view is given by Modigliani and Miller. Therefore, we call it as view. Now, what does this theory tells us? This theory argues with traditional theory stating that cost of capital remain the same. Whereas in traditional view, cost of capital is not fixed. Whereas view says cost of capital is constant, no matter whether a company is changing its financing capability. If you are taking your debts, if you are taking any kind of a risk, that should not, your cost of capital does not change. It is fixed at any moment of time. So this particular theory says that investors, they are at risk of debt and equity. Ultimately, that does not affect your capital structure nor your overall cost. This is your modern view, okay, which is given by Modigliani and Miller. Are you able to figure out the difference between traditional and modern? Simple. In traditional, cost of capital is not fixed, whereas here the cost of capital is constant. Okay. Whereas in traditional view, company uses more debt. More debt means more risk will be there, right? And more interest payment you have to go on with. Here, when it is constant, then you don't have to worry about risk. You don't have to worry about debt. This is what says, Modigliani and Miller says. Okay. And it is not supported. Only at certain places, I can say, where it is being followed. Okay. Now, next coming towards importance of cost of capital. That is, what is the necessity for it? Why do companies calculate cost of capital? Basically, companies calculate cost of capital. Second. Yes. Basically, the cost of capital helps us to identify an investment decision. It helps in financing decision, and also it helps in valuation of a company. Okay. Coming towards first, that is helps in investment decision. Okay. How the cost of capital helps in investment decision. Let's try to compare the cost of capital with our expected returns. Okay. If a project earns more than the cost of capital, then it is profitable, right? If we are earning more than what we have invested, that is profitable. If it earns less than cost of capital, then we should not invest it, right? For example, a company is planning to invest in a new project. Our cost of capital is 10%, for example, and our return is 15%. That means 15% is greater than 10%. Should we accept the project or reject the project? 15% is greater than 10%. That means we are getting 15% of profit on what we have invested, that is 10%. Okay, should we accept the project or should we reject the project? Accept the project,
Yes, ma'am.
right? This is how you have to make your investment decision. Next, how it helps in your financing decision. Here, the company has to decide how much debt and how much equity that you have to use it. Okay, if your debt is cheaper than equity, then you may be preferring more debt. That means if your debt is less than equity, then you may be having more debt. But too much debt, that ultimately increases your risk. If you have got more debt, then more interest payment will be there. Ultimately, your risk will be more, right?
Yes, ma'am.
For example, a company wants to raise a 50 crore project. If you are taking 9% loan interest and if you are paying regularly and you are getting 12% and there is no fixed payment, what is happening over here? Here, the risk is very low. So whenever you are investing, okay, you have to keep it in mind what is your debt and how much equity you are getting from it. Okay, if your debt is less and equity is more, then try to go in that project. If at all, if you are able to get more debts means ultimately you will be at more risk. You have to pay more interest at that time. Don't ever try to invest in a project. Okay. Third thing, how it helps in valuation of a company. Valuation in the sense, what are we trying to evaluate here? The company's worth. Okay. That means here the investors will try to use the cost of capital just to determine the company worth. Okay. That is whether the company return is higher than the cost of capital or not. If it is higher, then ultimately the company worth increases. Okay. If you have got higher returns, then your worth increases. You will have a good name in the market. Okay. If a company is earning 20% return with 10% cost of capital, this is profitable. If you are earning 5% return with 10% cost of capital, ultimately you will be in trouble. There will be no worth of your company. Okay. So the concept of capital helps you to decide the worth of a company as well. Okay. So these are the three things why you go on for cost of capital. That is, it helps you to take investment decision. It helps you to take your financing decision. It helps you to calculate the valuation of your company.
पानी बाहर आ
Now, next you have classification of cost of capital. Okay. In this, you have got different classification of your cost of capital. The first is your explicit and implicit cost of capital. Then you have your specific and overall cost of capital. In this, again, you have segregation, specific cost of capital, then overall cost of capital. And the last you have cost of debt versus cost of equity. Okay, these are the three classification of cost of capital. Coming towards the first, that is explicit and implicit cost of capital. Explicit cost of capital. Basically, the explicit cost of capital is the actual cost of a company that is required to pay your capital. Okay, basic example is your interest on debt or the dividends that you give to your shareholders. Okay, implicit is nothing but opportunity cost of using money. In your explicit, you are taking actual cost into consideration, whereas in implicit, you are taking opportunity cost. So how you are going to calculate opportunity cost? For example, if a company is using its own reserves, that means its own assets, instead of borrowing from some other agency. So what will happen? It loses the chance to invest those reserves. Okay. Where we want to invest it, instead of using it there, we are using it for our own purpose. That means we will not face any profit, neither instead will be facing any losses. So this is how you'll be going up with explicit and implicit cost of capital. Next, you have it as specific and overall cost of capital. Okay. Coming towards the first, that is specific cost of capital. This is calculated by raising each type of capital that you are using separately, whether it is your cost of debt, whether it is your cost of equity, or whether it is your retained earnings. Separately, you are just calculating each and everything. Now, what do you mean by overall cost of capital? Overall cost of capital is nothing but it is mentioned here, weighted average cost of capital minus this thing. That means here we are just trying to calculate the average of all types of capital. Okay, that is your debt, your equity, your retained earnings. All these things we are just calculating in your overall cost of capital. That is referred to as weighted average. Why we are going with weighted average? Because we are calculating the average of average cost of all capital costs. Okay, that is your debt, equity, cost of debt, cost of equity. Okay. Next you have is cost of debt versus cost of equity. Okay. What do you mean by cost of debt? Cost of debt is nothing but the interest rate that you will be paying to a company that you have taken loans. Okay. Usually, lower the cost of equity becomes the interest. That is tax minus deductible. Okay. For example, you have got a loan of interest 8%. And also you have a cost of debt as 8%. 8% minus 8%. You are at equitability range, right? There is no cost of debt on you incurred on you. It is much lower than the cost of the equity. Coming towards cost of equity. Okay, this is calculated on how you are able to get the return on your investors. That is, return investors they expect when they buy shares from your company. So higher the cost of debt because shareholders may try to take more risk. If investors is expecting 12% return and cost of equity is 12%, then again there is no choice of happiness nor you might be facing any loss or risk in your business. So at last what we can conclude, the cost of capital should be the minimum return that we are giving to satisfy to our investors. Okay. And here, when we are calculating weighted average cost of capital, it varies for debt as well as for equity. So the companies must earn more than the cost of capital to create worth of your company, to create value for your company. Okay. If you're earning more, then you will be having a good value in the market, or else no investors will try to share in your company. Okay. Now, next you have factors and problems in determining a firm's capital structure. Okay. First of all, what do you mean by a capital structure? Capital structure refers to the mix of debt and equity a company uses to finance its growth and operations. Okay. So in today's era, capital structure is one of the important concept of your financing decisions. Okay. As I already told you, like for example, you are starting a business. For that, you need 10 lakhs. You are borrowing from your bank, that is your debt, and you will try to share sales to your investors. This is a kind of equity. So the way you divide this debt and equity, this is nothing but this is your capital structure. Okay. How you are dividing your 40% and your 60% of your 10 lakhs. For example, you are taking 6 lakhs from a bank and 4 lakhs from your investors. You're just dividing 60% and 40%. This percentage is nothing but, this is nothing but your capital structure. Okay. That is the division of your debt and equity is called your capital structure. Okay. Ultimately, why do you need this capital structure? To minimize your cost and to maximize your profitability. Because for each and every company, ultimate what is the goal for it? To minimize its cost and maximize the profitability. Okay. This you call it as capital structure. Okay. Now, what are the factors that affects your capital structure? That we are going to see now. The first is your nature and size of business. Okay. Nature and size of business. Second is cost of debt and equity. Third is risk factor. Fourth, profitability of the firm. Next, flexibility in capital structure. Next, control consideration. Government policies and tax benefits. And the last is your market conditions. Okay. Coming towards the first, that is nature and size of business. Okay. This goes on with whether you maintain a stable business, whether you have large business. If you have large business, you can take more debts because you will be having steady profits in your business, right? If you have a small business, you prefer equity. Equity holders. You try to sell your shares to the investors just to avoid fixed interest payments because your business is too small. If your business is large, you'll be having, you can take loans from other banking institutions. When you are taking loans, you'll be having more debt. Okay. And you will be in a position, you will be at a capacity of paying more profits, steady profits. When you are expecting steady profits, you'll be in a position to repay the interest amount to those banking institutions from where you have taken the loan. Okay. So the firm's capital structure is dependent on nature and size of business. Okay. The steel company. Steel company is at large scale and stable. No doubt, evergreen, this business will move on 24 by 7, all days in a week, all months in a year. So these people can take more debt because this is working on a large scale and this is a stable business. For example, a new startup company is there whose future is not predicted. They try to go on with equity funding, right? They will try to take from investors. They will try to borrow from investors instead of going to a bank. Okay. Second factor is cost of debt and equity. If your interest rates are low, then company may prefer debt financing. If your debt is costly, the company will try to raise its fund using your equity. Okay. Like for example, a bank is offering you a loan at 5%. The company may try to take a debt. But if that loan is increased to 12%, okay, what we will try to do, instead of coming to a more in a debt position, we'll try to prefer selling our shares of the company. This is how we can just change the mode of our business. Okay. Third factor is risk factor. Okay. Higher debt means higher financial risk. Okay. That means here risk of bankruptcy will be there if profits fall. Higher equity means less financial risk will be there. Okay. For example, if a business is earning irregular profits, if you are earning irregular profits, then you should avoid debt because fixed interest payments might be difficult for you to pay. Okay. If you are getting good profit, regular profit, then you can take loans from the company and you can even pay the debt. But if you are getting irregular profits, then you should avoid debt because you are not in a position to pay interest to a bank. That becomes difficult for you to pay it. Okay. Next factor is profitability of the firm. Profitable companies, they afford higher debts because they can easily pay interest. But less profitable companies, they try to avoid debts to reduce their burden. Okay. For example, a company is earning 50 crore of profit. Okay. If you are earning 50 crore profit, you can easily handle 20 crore debt. Right? But if a company is earning 1 crore, okay, and you're getting 20 crore debt, then in that case, you should avoid excessive debt, right? 50 crore in profit, okay. 20 crore, you are experiencing risk or you are experiencing debt. That's okay. But if you are earning only 1 crore, then in such a case, you should avoid debt, right? Next is flexibility in capital structure. Companies, they may try to prefer capital structure that can be changed easily. Okay. Like for example, if a company needs more money urgently, then it should have quick access to debt or equity financing. Okay. The company should be in a position to need sudden expansion funds. Okay. You might either prefer your bank loans, okay, rather than selling your shares from wherever you're getting the funds quickly. Just try to adapt to it. Okay. You should be flexible in taking it at any moment of time. Any of your banking institution or your investors should be in a position to give you the funds. Okay. Next is control consideration. Control consideration, this is one of the factor that should be there in our hands. Okay. If a company is issuing more shares, then it has ownership with new investors. If a company takes a loan, ownership remains unchanged. Okay. For example, you have a family owned business. You prefer debt to avoid losing control to outside shareholders. Okay. If you are into a family business, okay, instead of going on with the concept of equity, you will try to go on with bank loan so that you will be repaying it, but you will not lose your entity, you will not lose your business. Okay, so this is in our hands how we have to tackle the situation based upon the circumstances. Next, you have government policies and tax benefits. Okay, interest on debt, that whatever that is incurred is tax deductible, making it a very cheaper option. So here the government has to regularize its taxation policies or restrict, or else you have to restrict your excessive borrowings from your banking institutions. Okay. If the corporate tax rate is high, if the corporate tax rate is high, then debt financing is beneficial in order to reduce your taxable income. Okay. This is one of the factor that you have to keenly observe into it. Ultimately, last is the market condition. Okay. If you have got a very strong stock market, then you may be preferring selling your shares, that is your equity. If you are in a weak market, then we try to prefer debt financing, right? So if the stock market is booming, a company can issue shares at a higher price and raise more funds. So that ultimately depends on your market condition. So these are some of the factors where it affects your capital structure. Now, next you have what are the problems that are determined in capital structure. Okay. Even though the company analyze its various factors, still we have many challenges where we have to decide the best capital structure ability. Okay. So what are the problems that are faced? The first is difficulty in estimating future projects. Second is balancing debt and equity. Third is interest rate fluctuations. Fourth is availability of funds. Next, industry norms and strategies. Last is unforeseen economic and business condition. Coming towards the first, that is difficulty in estimating future profits. The companies may need steady profits to repay its debts. Okay. If your future earnings are uncertain, that means are not predictable, then choosing the right capital structure will be difficult for you, right? If your future earnings are unpredictable or uncertain, then it may be highly difficult for you to choose your right capital structure. Okay. For example, a tourism company is there. So this tourism company, it depends on seasonal profits. Okay. If your travel demand is high, they may be expecting steady profits. If your travel demand drops, it may struggle to repay its loans. There is no, I mean, during certain seasons, during certain occasions only, you'll be expecting your tourism company to get their steady profits. But during unseasonal trend, at that time, you cannot expect that many profits. So in that particular scenario, the company may be facing a struggle to repay its loans, right? So this is one of the difficulty. Next is how to balance your debt and equity. Just now I told you, if you have too much debt, it increases your financial risk. Too much equity, it reduces your earnings per share. Okay. For example, if a company takes too much debt, interest payments can become unmanageable during recession period. Okay. So that thing you have to manage it. Third, interest rate fluctuations. If interest rate increases, ultimately cost of borrowing becomes higher. Okay. If suddenly there is a increase in your interest rate, then we might think twice to just borrow from your banking institution. So ultimately, the cost of borrowing becomes very much higher. So here, the companies cannot predict future loan costs accurately. Okay. For example, a company is borrowing a 10 crore of interest, a 10 crore at 7% interest. After 2 years, the bank is trying to increase its interest rate to 10%. What will happen? Our debt repayments become costlier, right? So this is one of the factor. This is one of the problem that helps in determining your capital structure. Next is your availability of funds. Okay. Some companies they try to struggle to get their bank loans due to poor credit history. If you have got a very poor credit history, you may not be getting the loans easily. And also, the investors may be getting hesitated to buy shares from you because your business is risky. Okay. So, a startup business with no track record, those businesses will find very hard to get loans from bank. Okay. Easily, you will not get funds from any banking institution or from your investors. This is also one of the problem. Next is industry norms and competitor strategies. Okay. Many companies, they try to follow the policy what competitors are doing. However, we try to copy other company capital structure. Sometimes it may work, sometimes it may not work. Okay. For example, if a competitor is using 70% of its debt, another company they might copy it without considering its own risk. Why? Because that company is going with 70% debt. Why not? We should go for it. Maybe we could be expecting some profits. But that is not the case. We will be at our own risk. Okay. So that should not happen. Next is unforeseen economic and business condition. Economic recession or market crashes. Ultimately, it impacts your capital structure decision. We may not knowing it at what time your company will be coming to a downfall position. Okay. So company might plan for debt financing, but because of economic downturn, they may not make repayment difficult. It may becomes very difficult for the company to go for repayment if you are at a very recession stage. Okay, like how you have seen many business they took loans before COVID-19, but as this lockdown occurred, they reduce. I mean, these company reduced their income, for which it was very difficult for them to go for loan repayments. This is somewhat unpredictable situation that we faced, that we have come across. This is unforeseen economic condition, you can say, wherein it was not there in our plan. It was unpredictable. It took place and we faced much difficulty. So the right capital structure, whatever that you are choosing, it should balance your debt and equity to ensure your low cost and your high returns. There might be many factors that influence your capital structure, such as your profitability or your market condition, your tax benefit, your risk. But you should always struggle with uncertainties that include your interest rate, that goes on with economic conditions as well, and you should be in a position of having availability of funds in your hand. Okay, so a good thought is something like a good capital structure should be flexible, it should be cost effective, and also it should minimize your financial risk. Okay, now next is what do you mean by capital structure and finance structure? We have been going on discussing capital structure, right? Capital structure is nothing but the proportion of debt and equity that is used. Now, what do you mean by a finance structure? Finance structure refers to the entire mix of liabilities and equity a company uses to finance its assets. That is referred to as your finance structure. Okay? A company refers to the entire mix of liabilities and equity to finance its assets. Whereas capital structure, it requires to proportion of debt and equity. Whereas here, entire mix. So you can able to figure out the difference between capital structure and finance structure. Here I have got some differences between capital structure and finance structure. Let's have a look onto it. Capital structure includes long-term sources of finance, whereas finance structure includes both short-term as well as long-term. Capital structure, it focuses on permanent financing, whereas here it focuses on all financial sources that are used in the company. Capital structure helps in investment and growth decision, whereas finance structure helps in understanding total liabilities of the company. Okay, easily, I mean, you can able to figure out the difference, and this is one of the important question that you can expect in your short answers. If at all, if it is coming in long answers, apart from this differences, you'll be having one more question explain in detail about capital or finance structure, and then list out the differences between these two. Okay, so then you could be going with these points. These are very simple. Okay, now next coming towards various forms of capital structure. Okay, a company has got its various forms of capital structure depending on how they mix debt and equity. The first is equity financing. Equity financing only means debt value is zero here. That is zero debt capital structure. Okay, what happens in this? The company will try to finance its operation only on equities, that is only on shares and your retained earnings. Here there is no debt. So ultimately, no interest payment. When there is no interest payment, no financial burden, less risk of bankruptcy. Okay. Ultimately, what is the disadvantage? The shareholders will demand higher returns because your earnings are diluted. Diluted in the sense, whatever the profits that you are earning, you have to share this profit among your shareholders. Right? So, advantage also it is there, disadvantages also it is there. Advantages, no financial burden will be there and less risk of bankruptcy. But ultimately, what is the disadvantage? Your shareholders may be demanding higher returns. Okay. Why do they get demand for higher end? Because you'll be getting profits and your profits will be divided among them. Right? Next, debt financing. Debt financing only. Debt financing only means no equity, zero equity. Okay. Zero equity means high leveraged capital structure. The company will have its operations only on debt only. That is with your bank loans and bonds. There will be no equity financing here. That means full control stays with the owner only. No shareholders here. Okay. So what is the advantage? Whatever the profit or loss you will be getting, you will be only using it. Okay. There will be no dilution of your ownership. And interest is tax deductible. It reduces your overall tax payments. Ultimately, what is the disadvantage? High financial risk will be there because ultimately you have to pay interest whether you're facing profit or if you are in loss. Ultimately you have to pay the interest of it. If profit falls, the company may face bankruptcy. because being a owner of the company, you alone have to face all the situations in your debt financing. In your debt financing only, no concept of equity, right? Next is balanced capital structure. What do you mean by balanced capital structure? Where you have optimal mix of debt and equity. Okay, here you are using both debt as well as your equity, but in optimal proportion. Okay, so when you are using it in optimal proportion, ultimately it reduces your overall financing cost while keeping your risk under control. Okay, so what are the advantages of it? You will have lower cost of capital, that is, your debt is cheaper, but your equity gives flexibility, and you'll be having less risk when compared to 100% risk. Okay, and what is the disadvantage? You should be more careful. That means you should, here it requires more careful management to avoid too much debt. Okay, so either you can go with 60%, 40%. 60% you are taking from banking institution as debt, and 40% you are just selling your shares to your investors, that is equity. So 60% debt, 40% equity. This is how you will be going on with the concept of capital structure, 60-40. So optimal proportion of debt as well as equity you are using. So 60% of debt you are using and 40% of equity you are using. Okay. Next form is highly leveraged capital structure. Highly leveraged means more debt when compared to equity. Whereas in the previous, we had some 60% debt and 40% equity. So this is one of the example, you can take it over here. So in this particular form, a company will rely more on debt rather than equity for its financing operations. So here the company will enjoy tax benefits but faces financial risk. High financial risk that too. Okay? Like 60-40. Or else you can say 80% debt, 20% equity. Okay? So this is one of the form of your highly leveraged capital structure. Now, next you have, what are the factors determining capital structure? I think just now we have seen this, right? Yes. Now, next is theories of capital structure. Okay. Basically, you have got nearly 6 theories of capital structure. Okay. What are those 6 theories? The first is net income approach, net operating income approach, approach, trade-off theory, pecking order theory, and the last is market timing theory. Okay, these are the 6 theories of your capital structure. Coming towards the first, that is net income theory. Now, what happens in this particular theory? Whatever the theories that we are discussing in this capital structure, that ultimately helps you to decide the mix of debt and equity to finance your operation. So the right capital structure theory, it minimizes the cost of capital and it maximizes the value of your company, that is the firm's value. So in order to determine this, we have these theories. Coming towards the first theory, that is net income approach. Okay, what does this theory tells you? This is one of the traditional theory, one of the oldest theory. Okay, this theory was proposed by David Duran and it suggests higher debt leads to higher firm value due to lower cost capital. That means if you have more debt, then lower cost of capital. Ultimately, higher firm value. Okay, so in this case, the weighted average cost of capital decreases as your debt increases. Okay, for example, if a company is replacing its expensive equity with 15% return and cheaper debt at 8% return, 8% interest. So here what is happening? The overall cost of capital reduces from 15% to 8%. When it is getting reduced, ultimately it increases your firm value. That means excessive debt increases financial risk, which is not included in this theory, which is ignored in this theory. Okay. What does this theory tell you? If you have more debt, it lowers your cost of capital and it increases your high firm value. But excessive debt, it increases your financial risk. This is not mentioned by in this theory. Okay, so this is one of the disadvantage, or you can say this is one of the criticism that goes on with this traditional theory. Next theory we have is net operating income theory. Okay, what does this theory tells you? This is completely opposite to the above one. This is also given by David Durand only. This theory states that capital structure does not affect firm value. We have seen this in MM theory if you remember. There it was constant, right? So the same concept was used by David Durand in your net operating income. Okay. So what does this theory tells you? The market value of a firm based on operating income, not debt equity mix. That means here it is constant. The market value is ultimately dependent on your operating income, not on your debt and the equity that you are mixing it. Next, increasing debt raises financial risk. This is what we have seen. It should happen, but this was not included in the above theory. It increases debt, raising financial risk, and also increasing required return on equity, keeping weighted average cost of capital constant. Here, weighted average cost of capital is constant. Okay, I give you a small example. You know this Tesla company, TSLA. Okay, if Tesla is trying to raise its debt more, ultimately what will happen? The shareholders will demand high returns. The shareholders will demand high returns because of increased risk. And this could be something offsetting we are trying to save from our costs, from your debt. Okay. But what is the fact? What is the fact? The real world, it suggests that capital structure affects your firm value. This is what this theory tells you. Whatever the capital structure that you are using, it affects your firm value, keeping your weighted average cost of capital constant. Okay. Again, this was one of the criticism. In order to avoid this, another theory came. That is your MM theory, we call it as. Okay. Modigliani and Miller theory. This is one of the modern theory. What does this theory tells you? This theory assumes no taxes, no bankruptcy cost, or transaction cost. In the first proposition, investors can borrow at the same rate as firms. Whatever the firms that they are borrowing from their banking institutions, even investors can borrow the same from it. Okay. Now, no taxes. Without taxes means your capital structure is irrelevant because firm value is not defined here. How do you define firm value? Firm value depends on your earnings. Firm value depends on your business risk, not on the debt equity ratio. Right? If we are able to see with respect to taxes, debt financing is beneficial when your interest is deductible to tax. That means reducing your taxable income. So in this case, the firms should use as much as debt possible to maximize the value. Okay. For example, if Google is financing its expansion using debts, ultimately Google will be getting its tax benefits by reducing the effective cost of capital. But what is the disadvantage? When excessive debt increases, we will have high bankruptcy. That means the risk is high. Again, the concept of risk is not discussed in this theory. That means each and every theory, it has got its own advantages and it has got its own disadvantages in the form of criticism. Okay, एक करे तो एक हो रहा, एक करे तो एक हो रहा. Okay, so again in this modern view, we have one more criticism where we are not discussing about the risk, because risk is also one of the important factor. Okay, so in order to study about risk, in order to study about tax benefit, one more theory came into existence that we call it as trade-off theory. Trade-off theory, it balances your debt and equity. Okay, trade-off theory balances your debt and equity. Now, what does this theory tells you? This theory suggests that firms balance tax benefits of debt with bankruptcy risk. Okay, you have to balance your tax along with your risk. Debt advantage, that means interest tax shield lowers your cost. Disadvantage in taking a debt, too much debt increases, bankruptcy chances increases. What does the optimal capital structure theory tells you? There should be a balance between these two factors, between your debt as well as your equity. Right? Are you able to figure it out? You know the sport company, Ford Motors. Okay? If Ford Motors, if it is trying to increase its debt, okay, in 2015, just to benefit from tax shield, but later on it reduced to financial distress, because here the tax was increased, the concept of tax was increased, and ultimately the risk was high in taking your debts from your banking institution. Okay. Next theory is your pecking order theory. Pecking order theory. This is based on preference-based financing. And this theory is proposed by Mayers and Majlaf. This suggests how firms follow a hierarchy in financing. Okay, so how it goes? Internal funds lowers cost. Debts, it moderate cost. Equity, higher cost. Okay, internal funds, it lowers your cost. Internal funds are nothing but the retained earnings that you are getting from your shares. It lowers your cost. Debt, up to some extent, you can moderate your cost by taking debts from banking institutions. Equity, highest cost. Okay, like Apple company. Apple company will try to prefer retained earnings for fundings rather than issuing new shares, just to avoid dilution. So whatever the stocks that were issued, based on those stocks only, based on those shares only, they will try to earn the retained earnings. But ultimately, what is the criticism? It does not consider optimal capital structure. Only a preference order is being used over here. We are not going with any new concept. We are not going with any new share. Instead, whatever the shares that were sold already, with respect to those shares only, we are playing. We are not introducing any share to the investors, or we are not selling any of the share to any of the investors. So this is one of the criticism. Okay. So in order to avoid that, another theory came. This theory, we call it as market timing theory. Okay. This theory is basically dependent on stock price influence. Okay. So what does this theory tells you? This theory tells you firms issue equity when stock prices are high and borrow debts when interest rates are low. This is one of the best theory, right? When we have a good worth, when we have a good value of our company in the market, ultimately our equity price increases. When our price increases, then only you should issue equities in the market. And also, when the interest rates are low, then only you try to borrow debt from your banking institution. Okay, so this theory explains why companies adjust their financing strategy based on market condition. This is one of the, like, as of now, this is one of the best theory that is being assumed. Because when Tesla, when there was a fluctuation in their share price in 2020, I think, in 2020 or 21, it issued more shares rather than taking debts from banking institution. It tried to sell more shares in the company when they were coming to a downfall. Okay, so that ultimately depends on the timing what that company was facing, and this was something uncertain, not there in our plan. Okay, suddenly it happened. Okay, so there they went on with market timing theory. Instead of taking debt from any banking institution, why not to sell shares of our company itself? Because we have got this Tesla has got a very good name in the market. So they try to sell more shares in the market in 2020 or 2021, I think. So ultimately that reduces their risk, debt risk. Okay. So here, each and every theory, it has got its own insight on how the company, what do you say, on how the company will able to decide their capital structure. But in reality, all the firms, they uses the mix of all these theories that we have seen, trade-off theory, pecking order theory, your market timing theory, just to optimize their financing strategy. Is it clear to you all? So this capital theories is one of the important question from the point of your external. You can definitely expect this question in your external theories of capital structure.
Okay, ma'am.
Okay.
Okay.
So I'll just wind up my class over here.
Okay.
Okay.
Last, I think, madam. Block 4.
Yeah. Yeah. Last class is next week, right?
Next week is
So
the last class
yeah,
to the
next week I'll just
15th.
try to cover. I mean, we are in block 4 right now. So half part of block 4, then block 5 we need to cover. So we'll just look into it. Okay. Think positively. If possible, we'll just try to complete it. This subject is very vast.
Yeah,
Yes,
the
ma'am.
only theory, I think.
Theory is more. I mean, in theory also, you have got more subheadings.
Yes, ma'am.
Okay. We
More
can write
subheadings you have to.
material also, madam, that answers and this PPT also.
See, I'll share you the PPT. I don't have proper notes for it. I just share with you this PPT that includes your side heads, side
Means
headings.
all blocks.
Yeah, all blocks I'll send you.
Yeah, yeah. First one is block 1, introduction to business finance, and block 2 is
Yes, yes.
financial
That's
markets,
what I'm telling you,
financial.
na. This subject is more of theory, and you
Yeah,
have got more side headings. I mean,
yeah,
very deep subject, you can say.
yeah.
Yes, ma'am.
Okay. So
Okay,
Mm.
as
ma'am.
much as possible, I'll just try to complete it because we are left with only one class. So I'll just go very fast in that particular class. And you just provide me with your uh, email ID, or else if you have your contact number, I'll give you my contact number. Okay.
And
So I'll
actually,
just
we have a
trying to,
group, ma'am.
I'm
Shall
not
I send
included
it?
in that group. Yeah. If you have a group, you can just add me into that group.
Okay, ma'am. Thank you, ma'am.
Okay.
Okay,
You
ma'am.
have my number.
Yeah,
Yes, ma'am,
madam,
I
I
have.
have. I
Yes,
have.
you just add me to that group so that
Okay, ma'am.
at any moment of time, I'll just send you the important questions as well as the PPTs that I have shared you in my class.
And
Sure, ma'am.
one
Sure, ma'am.
short
Thank you,
and
ma'am.
long also, madam.
Sorry,
Short questions and long questions also.
long questions I'll give you. Anyhow, short will be covered in long only.
Okay.
Okay. You, if you
Okay.
just prepare for long, ultimately you can write short answers as well.
You can write on
Because
also, madam.
basically, sorry,
We can write on also for explanation in side headings also.
own means it should be as per the question what is being asked.
Yeah, yeah.
Don't write
Side
your
headings.
own points which does not match as per the requirement,
Okay.
Okay, ma'am.
right? It should be clear. I mean,
Yeah.
it should be correct if you are writing it in own also.
Okay.
The question is being asked something and you are writing something in that does not match. Don't think
Okay.
you'll be getting marks for it. Whatever that is being asked, with respect to that only you should. For example, write English alphabets, capital
Yeah.
letters. In capital letters, you are writing small letters, numbers, everything you are writing means you will not get it.
Okay.
Okay, so start in that manner accordingly. Fine. So I'll just
Yeah.
wind up my class over here. Okay, thank you all for attending my session.
Yeah.
Thank you,
Have
ma'am.
a good day. Thank you.
Okay, ma'am. Thank you, ma'am.
Thank you.
Yeah. Can I leave, madam?
Sure, sure, you can leave. Even I'm just ending my session.
Yeah. Yeah. And you are not coming in video, madam. Your screen is coming.
The bandwidth is too low. If I come on screen, I cannot share the PPT.
Oh, okay.
This is what it is happening.
After that, your PPT means you can also show. Okay.